Today's February 12th, 2025, and the Consumer Price Index was released this morning, and unfortunately, it showed signs of inflation, which of course, the stock market reacted negatively, the bond market reacted negatively, and when looking at the media, you would immediately think, well, mortgage rates are not going to do very well in this environment. They're probably going to increase substantially. And so I wanted to give some transparency to clients and consumers or people thinking about purchasing real estate, what the reaction was to rates. For example, when I quoted a rate on Monday in my newsletter, I send out a rate sheet that includes what rates would be if you have, favorable credit scores of 780 or higher, and for a primary home, putting down 5 to 25% down. And so that rate on Monday that I quoted was 6.875 with no points. And now that we've had this unfavorable inflation news, I wanted to give some transparency to clients of what rates would actually be now that we have some negative reports on inflation. And so the rate now, whether you're putting down 5 to 25% down, really is only an eighth higher. It does vary a little bit with how much money you're putting down and what a lender can do to honor the pricing that they're quoting you. But for simplicity and just make it easily digestible for people, the rate was 6.875% on Monday with no points, with credit scores of 780 or higher, with 5 to 25% down. Now, a few days later, being Wednesday afternoon, the rates after this inflation news was released is only an eighth higher. It's just really not that substantial of a difference when it comes to how much worse mortgage rates are. If you, for example, you were borrowing, I ran some numbers this morning, so I have this fresh in my mind. But if you were borrowing around, $300,000 or so, you're probably going to save between that 0.125 of 6.875 to 7%, somewhere around like $25 a payment, give or take, right? Just as a general idea. So that inflation news basically increased your payment by $25. And I just don't think that most people that are interested in purchasing real estate are going to make a decision based on $25 each month. I think if you're seriously considering moving forward this year in 2025, I hope that gives you some clarity that rates are still in the same ballpark, around 7% they've been really the past 3 or 4 weeks. And speaking of rates, a good way to track them if you're not going to receive a video or an update every day is to look at the bond market, look at the ticker TNX. It's a 10-year Treasury bond, and you can follow this ticker. I created a video about it on my Instagram and TikTok, and I sent it to a client recently talking about basically what's happened in the past in December through January, and it kind of gave me this idea to give this update now because I felt like it gave the client a lot of clarity about what strategy he wanted to use. Because at the end of the day, I can only give the options, and then the client or the borrower is going to make their decision based on the information they have. Looking at the 10-year Treasury X, you can kind of see, in the beginning of the week, if we looked at a 5-day chart, you could see TNX was basically at 4.5, and it moved up just 0.1. It moved up to 4.6. So not a big jump really at the end of the day, and hence not a huge jump in the mortgage rate difference. Based on 2025, in January, this ticker TNX, the 10-year Treasury note, was actually higher, was up closer to 4.8. So we're still below some of the highs that occurred last month in January of 2025. Just wanted to point out and give some transparency about rates. And I also wanted to point out some things in the article from CNBC as far as some of the inflation news that I would recommend reading just to be knowledgeable about the market. So after the Consumer Price Index was released, they adjusted for inflation, and the inflation number that was reported was an annual inflation rate of 3%, which one, obviously was in the wrong direction. Inflation isn't declining, it's increasing. And two, the Federal Reserve's goal for inflation is to be closer to 2%, or at least heading in that direction. So the immediate reaction from the Fed was that basically they're not likely to cut rates for several quarters, which is a little disappointing, of course, but that is necessarily not directly impacted to mortgage rates. The main point that I'm trying to get across to my audience is that the Federal Reserve's really not likely to cut rates for the next couple quarters. I think it's likely that we're going to have some bumps in the road as inflation data comes out. And I even put in one of my news articles that rates could even go as high as 7.5% to 8%. I do think that's possible in 2025. I think we're also more favorable probably to go lower in sometime into the fall. So I am hopeful that rates could, get in the mid to low sixes in 2025. But I think there could be some, increases in mortgage rates due to this inflation data, not this report specifically, but I'm more on the cautious side always right now in the current environment. So I hope this is helpful. I hope this gives some transparency to the market reaction. I, of course, won't lower rates as always for everybody, but I have to be honest about what I'm seeing in the market. And, currently we had a little uptick. It wasn't much. If you're borrowing, again, $300,000 to $400,000, probably about a $25 payment increase from this reaction February 12th of 2025. We'll just see where the market takes us. I encourage you to read an article about the inflation reports that came out. I'm reading the CNBC article. I'll put some links below if you'd like to be added to my news article. You can always leave a comment of your email or direct message me on Instagram or another platform. And then lastly, I hope you subscribe and like the video. It really helps the algorithm and helps me get out to my audience. So if you could like the video, we'd really appreciate it. And we'll talk to you next week.